According to Gallup.com, thus far in 2021, only 56% of Americans report owning a stock. In my book, that's not enough. And I imagine the remaining 44% of Americans that don't own a stock could benefit from owning them and learning a little more about them. My name is Nicholas Itali, and I paid off $60,000 of student loan debt in 11 months and now have over $200,000 in the stock market by the age of 24. So what is a stock? A stock is a piece or share of ownership of a company. Each share is worth a certain amount based on what the company is worth. Companies issue shares to investors in order to raise money. We can buy shares of publicly traded companies. You can think of shares as a measurement, although that word is almost interchangeable with stock. For example, I have stock in Google. More specifically, I have 50 shares of Google. Now that's a lot of mumbo jumbo. Let's see an example. Let's say I'm launching a camper converter company, Nick's Camper Conversions. I have 10 G's right now, but I need 100 grand to start this business. Vans ain't cheap. I want to buy a school bus to convert and all the materials and other things that go into starting a business. Right now, I'm $90,000 short, and one of the ways that companies can raise money is by selling a piece of itself. You know what I'm saying? Don't sell yourself. It's kind of what they're doing. Selling parts of themselves. I can break my company up into 10 pieces. It could be any amount, but I'm choosing 10 pieces. And then I can take these pieces and sell them to other people for partial ownership of the company. Other people could buy and own one or a few of these little pieces, and those little pieces are shares of stock. So in this example, there's 10 little pieces, which equates to 10 shares of Nick's Camper Conversions. I can sell each one of those shares for $10,000. I could keep one share and then sell the other 9 to get my $90,000 that I needed. Then there's 9 other people, or fewer, depending, if somebody bought more than one stock, that have ownership of the company. I own 10% now, and then the remaining 90% the shareholders own, so collectively we have 100% ownership of Nick's Camper Conversions. I have the $100,000 that I needed to start my business, and the shareholders are now stoked because they get to have a piece of the profits of my camper conversion company. If this makes sense so far, demolish that like button, baby.
Demolish it.
So how do stocks make money? Let's do another example. Let's say my friend Jake here purchases one share for $10,000 in Nick's Camper Conversion Company. Then over the course of the first year, my camper conversion company does wonderful. I make $100,000 in profit. I sold a few camper conversions, and after all the expenses are said and done, my company profited $100,000. Since Jake is a 10% owner of the company, he's entitled to 10% of the profits. So if my company profited $100,000 and there's 10 shares, we divide that 10 and he owns one of them, he just made $10,000 just by being invested and being an owner. And when you own a stock and you receive a payment from the profits of the company, that's called a dividend. A dividend is when a company earns a profit or a surplus and then pays a proportion of the profits to a shareholder. That's a dividend. The profits you're paid are in proportion to how much ownership of the company you have. For example, if you own 0.002% of Google, you would get paid 0.002% of the profits as dividends to you. Now, let's say my camper conversion company is just blowing up. It's going wild. People on social media are talking about it. Everyone loves this company. They're talking about how cool the vans are, and a lot of people want to have a piece of this company. Want a little ownership piece of the company. My friend Kyle hears about this commotion. He's like, I want in. So he goes up to Jake and he's like, Jake, let me buy that stock from you. Jake says, sure, but it's gonna cost you $25,000 because I made 10 G's in the first year and people are talking about it like crazy. This is a super high demand stock, so obviously the price is gonna be much higher. 25 G's, Kyle. Kyle agrees that it's a great stock, buys it for $25,000, and Jake just pulled in $25K. And this is the second way that stocks make money. The share price increases. To recap, Jake bought this stock or the share in the company for $10,000. He then received $10,000 of dividends in the first year, and then he sold it for $25,000. After it's all said and done, subtracting his gain minus the initial investment, he profited $25,000. Sale price, $25,000. Plus the dividends he got, $10,000, minus his initial investment of $10,000, still made 25 G's, which is an insane investment. Stocks don't always go up though. If the company is terrible, share prices are gonna go down. If investors think that a stock is going to go down, they're gonna sell to try to salvage the profits they have before the stock tanks. As shares of the company continue to be sold, the demand for this stock continues to go down, thus resulting in the share price also going down. Stock prices reflect whatever people are willing to pay for a piece of ownership of a company. For example, when you used to make trades at lunch in school, it was always 2 bags of chips for 1 snack pack. And then if you wanted a slice of pizza, it was a bag of chips and a snack pack for the slice of pizza. It was kind of like, what are you willing to trade to get the highest value thing? It's the same thing with stocks. What are people willing to pay to have a piece of the company? Stock prices are fairly unpredictable in the short term. However, in the long term, companies' underlying values and their potential earnings are slightly more predictable. Like what Tesla will cost today and tomorrow is far different from how we think they're going to perform in the long run. There are a lot of factors that determine the market value of a company, from fluctuating prices of materials, like we've seen with wood for homes, changes in the cost of labor, like we've seen with the ongoing minimum wage debate, investors seeing bad publicity of a company and wanting to pull out their stocks and shares, sell them right then and there, or new trading laws that hinder the ability for us to make more profit is a reason. And even people just selling their stock to cash out and go do whatever they want, that also plays a part in this. These are events that can cause a stock's price to drop even if a company is performing well internally. The mere appearance of losing value can oftentimes lead to them losing investors, and ultimately the company does lose value. Yikes. Long story short, there are 2 ways that stocks make money: share price increase and dividends. If a company performs well and grows, the demand for the stock will go up as well as the share price. If this video answers the question, what is a stock, please hit the like button and subscribe for more personal finance insights, baby. Comment what company you hold stock in, and I will see you in the next one. Goodbye.